What's up everyone, it's Caddy with Money Vesting. So in this video, we are going to be talking about the Fed's balance sheet. So I will be giving you an update on the Fed's runoff program. In other words, when they started rolling over the assets on their balance sheet, how that's going, how far behind the Fed is right now. They're actually not that far off. We'll talk a little bit about that. And then of course, we'll be talking a little bit about a new spreadsheet that I created talking about the cap rates, the dividend yields, and the earnings yields for the S&P 500 and the real estate market in the US, some of the more alternative investments as opposed to where the risk-free rate is, and doing some comparisons, and why this is a little bit of a scarier scenario in terms of flight to quality in the market and how we're actually playing it personally and what I'm actually doing right now. So hope you guys enjoyed this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel, and also the link to our Discord and Patreon is going to be down below if you're interested in joining us and get access to all the trade alerts, trade ideas. In fact, I did share a brand new video for all the members. This is a private Patreon only video posted 6 hours ago talking about 5 new trade ideas along with my analysis on the 10-year yields, the bond market, and talking about some bond prices, ETFs as well. So you can access this video, 25-minute long, going over all the trade setups, buy targets, profit targets, everything's going to be included. Links down below if you're interested. So first things first, let's just dive right into the Federal Reserve's balance sheet. And this is literally going to be their actual reserve balance in their depository institutions as of March 1st, 2023, which was the most recent release, actually March 2nd, 2023. And this is pretty much broken down into 2 different categories, right? We've got the U.S. Treasury securities. These are all your T-bills, bonds, notes, all those U.S. Treasuries and securities. And the second part is going to be the mortgage-backed securities. Now, this is a little bit more of a scary part because mortgage rates have already been going higher. They're now up to over 7% on a 30-year fixed. I did a complete video on the mortgage market and the real estate housing market earlier in the last week. So you can check that out if you haven't already. I mean, we already know the mortgage demand is down to a 28-year low sitting at 1995 levels because of how high rates have gone. And of course, the purchase index and the mortgage index are all plummeting right now at very, very low levels because of how high interest rates are. And of course, it's much cheaper to rent right now than it is to actually buy, considering how high interest rate and your monthly expenses can end up being. So mortgage rates, this is, despite the fact that the Federal Reserve still has over $2.6 trillion worth of MBS products on their balance sheet, mortgage rates have gone up to over 7%. This is after the fact that the Fed has MBS of over $2.6 trillion. If they start actively selling these securities, the real estate market would literally plummet because interest rate could really spike to higher levels because they would then be actively selling, participating in the market. And by them selling, obviously it will plummet the prices for MBS products, thereby pushing the yields higher because of that inverse correlation. But fortunately for us, they're not doing that right now. All they're really getting rid of is the US Treasury securities, and that's right now sitting at $5.336 trillion. But let's just compare to where we were versus where we are right now. So if you compare to May 2022, this was literally last year when they actually got started with this program, the US Treasuries were sitting at $5.76 trillion. And as of today, as of March 2nd, we're sitting at $5.3 trillion. So they have rolled off a little bit over $429 billion worth of US Treasuries. These are bills, notes, bonds, everything that is maturing is getting rolled off. They're not reinvesting it into new Treasuries, but instead they're just having those securities mature, collect the principal, and then move on. Same thing with MBS. However, the thing that's really interesting with MBS is that most of the mortgage-backed securities, as they're pooled together, are maturing in over 10 years, right? So you don't have that flexibility, you don't have that liquidity with mortgage-backed securities that you do with US Treasuries, because US Treasuries, you can buy 6 months, you can buy 1 year, you can buy 2 year, 3 year, 5 year. With mortgage-backed securities, unfortunately, if you come down a little bit and you pretty much look at the maturing securities, US Treasuries, you'll notice that within 15 days, there's $3.2 billion worth of US loans, and holdings, $41.5 billion worth are maturing in that time. Within 16 days to 90 days, we've got another $327 billion worth of US Treasuries maturing, which is obviously going to help this roll-off plan, right? Roll-off program. In other words, allow for these maturities to roll over. And then 91 days to 1 year, we got $712 billion, $1.8 trillion in 1 to 5 years. 5 to 10 years, another $908 billion. Over 10 years, 1.4. And then all the other ones are, of course, maturing over $5.3 trillion worth of US Treasuries will eventually mature, right? They're not going to hold on to them indefinitely. But what's really interesting is that if you come down to the mortgage-backed securities section, right, holdings, we've got zero, we've got $2 billion, a small $2 billion maturing in 16 to 90 days. We've got $23 billion in 91 days to 1 year. Majority of them, I mean, $7.8 billion, still not that significant, 1 to 5 years. And then we got 5 to 10 years, $47 billion, but majority of this MBS product is maturing in over 10 years, so $2.5 trillion. So that's why this number is going to be a lot lower. And even then, they have been able to reduce a little bit, $130 billion in mortgage-backed securities over the last year, coming in since May 22, when they were sitting at $2.7 trillion, and now they're down to 2.6. So overall, securities held outright, so SHOs are sitting at over 7.9, almost $8 trillion. Their balance sheet obviously is a little bit higher considering for all the other items that are also on the balance sheet. So right now they're sitting at 8.3 trillion, but off that 7.9 trillion is US Treasuries and securities in mortgage-backed securities here, and $600 billion is what they have pretty much allowed to roll over since May. Now, when they announced back in May that they are going to be rolling this process, June, July, August, they pretty much had a cap of $47.5 billion. And then starting September, they upped that cap to $95 billion. So if we take into account from May, when the process started, to February of 2023, total maturing securities should have been rolled off $712 billion. They have done it a little bit over $600 billion. So we're just a little bit shy and short $112 billion from the Federal Reserve, which is still a pretty substantial amount. And definitely is going to start to kind of push the interest rates a little bit higher, because what the Federal Reserve really is doing is they're taking demand away, right? They're taking liquidity away from the market, from the economy. And when that happens, of course, interest rates push higher because price starts to pull back because there's little to no demand. Now, that being said, because the demand is coming down, because the liquidity has been coming down, what you have noticed is obviously with all this quantitative tightening, interest rates have started to push right back up. So yields, 10-year yields, 1-year yield, 6-month, all treasuries, they've started to push back up. And this is a very good chart, which pretty much goes over risk tied versus risk free. So risk tied, what we have over here is the S&P 500 dividend yield, S&P 500 earnings yield, and the average United States real estate cap rate, right? So cap rate is how much you're making in profit when you're owning a real estate property. Of course, there's other metrics to look at, the internal rate of return, IRR, but cap rate is pretty widely used in the real estate world. So what we have over here is since 2015, what is that dividend yield? What is that earnings yield? And what is that cap rate? Now, for the longest time, up until 2021, these three pretty much had a premium position, right? They pretty much were the best of the best investments, right? Buying S&P 500, buying real estate, they were considered as where you can get premium, you can get a better return on investment, higher reward. So that's pretty much premium, because the 1 year, the 6 month were yielding less than 2%, less than 1%. They were not even looked at, especially not from retail and more institutional investors. But now, if you look at where we are in 2022, especially where we are in 2023, that premium over time has diminished because of all this quantitative tightening and the liquidity being sucked out of the market, and the yields are starting to push back higher. Not only on the concerns of potentially recession in 2023, but of course because of inflation as well. So why would any rational investor, just think about that for a second, why would any institutional investor that's managing big money would be interested in, say, investing in S&P 500 or on an aggregate basket of stocks? Or why would real estate investors be invested? Again, these are aggregate numbers, right? So there's going to be definitely extremes. You're going to find, individual stocks that are obviously yielding over 6%, 7% in earnings yield. Dividend yields are also higher. And at the same time, you've got expected stock returns, which are much higher. And then you can find properties that are yielding you over 10, 12, 15% cap rates. So we're not talking about those extreme scenarios or those anomalies, but these are more aggregate, more average numbers. So why would an institutional investor or real estate investor consider these instruments, these assets, as opposed to the risk-free rate, right, between the 1 year and the 6 month that can get you over 5%? That's the concept that I'm trying to help you understand. And as the liquidity starts to flood a little bit more towards these areas, which is your risk-free rate, I expect yields to start rolling back down, and as a result, bond prices to start pushing back up. And that's the entire thesis behind our potential trade idea in 2023, is a long duration bonds that I shared over in our Patreon as well. So this is the entire analysis that I wanted to share. Fortunately for us, the Federal Reserve is not, liquidating any mortgage-backed securities, and if they were, rates would completely skyrocket even higher. But at the moment, all they're really doing right now is trying to roll off US Treasuries as quickly as possible and kind of keep meeting their caps month over month. But we are in an environment, we are in a scenario right now, which is quite interesting, where you've got risk-free rates, 6-month, 1 year, climbing up to over 5%, although yields are starting to pull back a little bit. That's why we took a trade last week on TMF, and it's now starting to push back up. It's doing really well for us. So that's how I'm personally playing it. But let me know your thoughts down in the comment section below. And if this risk-tied, risk-free premium is going to continue to be diminished over time, or if the risk-tied, which is the earnings yield on the S&P, the dividend yield on the S&P, and the real estate cap on real estate market, is going to reclaim its premium position in 2023. Let me know down in the comment section below. As always, if you enjoyed this video, found it helpful, make sure that you drop a like, subscribe to the channel. It's always happy investing, and I'll see you all in the next video.